They told you the market was calm, but calm markets don't suddenly go silent where the data should be loudest. When the world's most important derivatives exchange blinks, even for a moment, it is never just a technical footnote. In modern finance, information is liquidity, and liquidity is trust. So when reporting falters, the shockwaves move faster than price. This is the story of one of those rare moments when the machinery behind global markets briefly revealed its fragility. Most people watch charts, headlines, and social media sentiment, believing that is where markets live. Professionals know the real market exists deeper, inside clearing systems, reporting pipelines, and institutional data flows that almost no retail participant ever sees. The Chicago Mercantile Exchange sits at the center of that hidden world, quietly processing trillions of dollars in futures and options every single day. It is not just an exchange. It is a backbone of global price discovery for rates, commodities, currencies, and risk itself. When something unusual happens there, it does not stay local and it does not stay small. Even a reporting disruption can alter perception, positioning, and behavior across continents. This particular event did not begin with a crash, a war, or a surprise policy announcement. It began with something far more unsettling to professionals: missing, delayed, or inconsistent information where certainty is assumed. At first glance, it looked like a routine technical hiccup, the kind markets have learned to ignore in an age of complex systems. But beneath the surface, traders, risk managers, and clearing members felt a familiar tightening in the chest. Markets run on assumptions that data will arrive on time, be accurate, and reconcile cleanly across systems. When those assumptions break, even briefly, the entire pricing structure becomes conditional. This is why experienced desks do not ask whether a disruption is large or small, but whether it touches critical reporting functions. The moment it does, the question shifts from inconvenience to systemic relevance. To understand why this matters, you must first understand what CME reporting actually does. Every trade executed on CME feeds into a chain of confirmations, margin calculations, settlement prices, and regulatory disclosures. These reports tell clearing firms how much collateral is required, tell regulators where risk is concentrated, and tell participants whether their positions are properly recognized. A disruption here is not like a delayed chart update. It is closer to momentary blindness. Imagine flying an aircraft where the instruments flicker, not long enough to crash, but long enough to make you question what you're seeing. That uncertainty forces pilots to slow down, change altitude, or even abort the route. Markets behave the same way under informational stress. Participants reduce size, widen spreads, and hesitate to deploy capital until confidence is restored. In this case, the first signs were subtle, noticed primarily by professionals who reconcile multiple data feeds. Certain reports did not align in expected timeframes, creating small but noticeable discrepancies. No alarms rang publicly, and no urgent statements appeared on mainstream financial news. That silence itself became a part of the signal for those paying attention. Large institutions do not react loudly, they react quietly and defensively. When something feels off, risk committees tighten limits long before the public becomes aware. Liquidity providers began adjusting behavior, not because prices demanded it, but because the informational environment had changed. This distinction is critical to understanding why such events matter even without dramatic price moves. Retail narratives often focus on visible outcomes like volatility spikes or crashes. Institutional reality focuses on invisible inputs like data integrity and operational certainty. The CME reporting disruption forced participants to ask a basic but dangerous question. Do we fully trust what we are seeing right now? In markets, hesitation is not neutral. It is destabilizing. Even a brief loss of confidence in reporting can cascade into delayed trades, postponed hedges, and conservative margin assumptions. Those behaviors collectively reduce market efficiency. The irony is that many of these effects never show up as dramatic candles on a chart. Instead, they show up as thinner order books, slower execution, and a general sense of caution that is hard to quantify. To the outside observer, the market appears normal. To insiders, it feels like driving on a highway where everyone suddenly lifts their foot off the accelerator. This is why reporting systems are considered critical infrastructure, not auxiliary services. They are the nervous system of financial markets. When the CME experienced this disruption, internal teams moved quickly to identify, isolate, and resolve the issue. That response itself is expected, but it does not erase the impact of the moment. Markets do not need prolonged failure to feel stress. They only need uncertainty. The memory of that uncertainty lingers even after systems are restored. Another overlooked aspect is how automated systems respond to reporting anomalies. Many trading algorithms rely on clean, timely data feeds to function properly. When those feeds degrade or become inconsistent, algorithms may pause, switch modes, or reduce activity entirely. This silent withdrawal of machine liquidity can amplify the human hesitation already underway. The result is a market that technically remains open, but functionally operates at reduced capacity. This state is rarely discussed publicly. Yet it is crucial to understanding intraday dynamics during unusual events. It is also important to separate malicious intent from systemic complexity. Not every disruption is manipulation, and not every anomaly signals wrongdoing. Modern exchanges operate some of the most complex technological systems on the planet. Complexity increases efficiency, but also increases the probability of rare, unexpected failure modes. However, professionals do not judge events solely by cause, they judge them by consequence. Even an innocent glitch can have outsized effects if it touches the wrong part of the system. The CME, reporting disruption, touched trust, and trust is nonlinear. It does not degrade gradually, it snaps, then slowly rebuilds. One of the reasons this event stands out is precisely because it did not come with immediate chaos. It was quiet, controlled, and quickly addressed, which makes it more instructive, not less. History shows that many major financial crises were preceded by smaller technical anomalies that were dismissed at the time. Those anomalies were not causes, but early indicators of systemic sensitivity. This does not mean every disruption foreshadows disaster. It means each one is a stress test, revealing how markets behave when assumptions are challenged. In this case, the market passed the test, but not without revealing its dependence on seamless reporting. That dependence is growing, not shrinking, as markets become faster and more automated. Regulators pay close attention to such events, even when public reaction is muted. Reporting disruptions trigger reviews, audits, and internal discussions that never reach headlines. These reviews focus on resilience, redundancy, and communication protocols. The goal is not to assign blame, but to reduce the chance of recurrence. For participants, the lesson is more practical. Markets are not just about price risk, they are about operational risk, and operational risk can surface without warning. Sophisticated investors factor this into position sizing, diversification, and liquidity planning. They know that the rarest events are often the most instructive. The CME reporting disruption is a reminder that markets are engineered systems, not natural phenomena. Engineered systems can fail in ways that feel unnatural to those who assume constant reliability. Understanding this changes how you interpret market calm. Calm does not always mean stability. Sometimes it means participants are waiting. Waiting is a powerful but fragile state. It can resolve into renewed confidence or sudden repricing, depending on what comes next. In this case, confidence returned as reporting normalized and confirmations aligned. The system absorbed the shock and continued functioning. Yet the memory of the event remains embedded in professional awareness. It becomes part of the mental library traders draw from when future anomalies appear. This is how market wisdom accumulates, not through headlines, but through lived experience of subtle disruptions. Each one adds context to the next. The real story here is not that something broke, but that something essential was briefly questioned. That question alone is enough to reshape behavior, even temporarily. As markets move forward, the infrastructure supporting them will only grow more complex. Complexity demands vigilance, humility, and constant stress testing. Events like this are not warnings of collapse, but reminders of fragility. Fragility does not imply weakness. It implies the need for respect. Those who understand this do not panic when systems flicker. They observe, adjust, and prepare. And that preparation, more than any headline or price move, is what separates professionals from spectators when the market does something unusual. What followed the normalization of reporting was not relief, but analysis. Institutions began replaying the event frame by frame, asking not what happened, but what it revealed about their own exposure to unseen risk. In professional environments, every disruption becomes a case study. Teams document timelines, decision points, and behavioral changes, not for compliance theater, but for survival memory. The first internal question was simple and uncomfortable. How quickly did we notice? Speed of awareness matters because it determines whether a firm reacts proactively or defensively. Firms with redundant data feeds detected inconsistencies earlier than those relying on single-source confirmation. That difference translated into calmer execution and tighter control over risk. The second question was about response discipline. Did desks slow down automatically, or did they wait for explicit instruction from risk management? This distinction separates resilient organizations from reactive ones. The best systems embed caution directly into workflows, reducing reliance on human judgment under stress. Another layer of analysis focused on margin and collateral calculations. Even brief reporting ambiguity can force clearing members to assume worst-case scenarios. Worst-case assumptions are expensive, but they are safer than optimistic ones. In that moment, capital efficiency takes a back seat to balance sheet integrity. Some firms quietly increased internal margin buffers. Others temporarily restricted new position openings, even as markets appeared stable on the surface. These actions rarely make headlines, yet they shape market behavior more than public commentary. They reduce participation exactly when confidence is fragile. Liquidity is often described as depth, but depth depends on willingness. Willingness evaporates faster than capital when uncertainty enters the system. This explains why markets can feel strangely thin without obvious volatility. The machinery is still running, but fewer hands are on the controls. Another subtle effect appeared in hedging behavior. Corporations and asset managers delayed adjustments, preferring to wait for confirmation rather than act on partial information. Delay introduces risk of its own, but it is a controlled risk. Acting on unreliable data can lock in errors that are far more costly. This trade-off between action and caution is central to professional market behavior. Retail narratives often miss this because charts do not show hesitation. Technology teams were also deeply involved in post-event reviews. They examined data pipelines, failover mechanisms, and alert thresholds. The goal was not just to prevent recurrence, but to shorten detection time. In complex systems, early detection often matters more than perfect prevention. Engineers understand that zero-failure environments are myths. Resilience comes from anticipating failure modes and designing graceful degradation. Graceful degradation means systems slow or simplify rather than break catastrophically. Markets favor this behavior because it buys time for human judgment. Communication protocols also came under scrutiny. Who was informed, how quickly, and with what level of clarity became key discussion points. Clear internal communication reduces rumor-driven decision-making. In moments of uncertainty, silence is often interpreted as danger. Externally, the exchange's measured response was intentional. Over-communication can cause panic, just as under-communication can breed mistrust. Balancing transparency with stability is one of the hardest tasks for market infrastructure providers. Every word carries potential consequences. Participants understand this, even if the public does not. They listen less to tone and more to consistency across actions and data. Once systems stabilized, reconciliation processes confirmed that trades, positions, and settlements were intact. That confirmation mattered more than any press release. Markets do not need perfection, but they need closure. Closure restores the assumption that the past is settled and the future is predictable again. Yet predictability in markets is always conditional. This event reminded participants that conditions can change without warning. The broader implication reaches beyond a single exchange. Global markets are increasingly interconnected through shared infrastructure and synchronized behavior. A reporting issue in one core node can ripple through pricing models, risk calculations, and portfolio allocations worldwide. The system is efficient but tightly coupled. Tight coupling increases speed but reduces tolerance for error. Small disruptions can propagate faster than institutions can fully understand them. This is why stress testing has expanded from market scenarios to operational scenarios. Firms now simulate not just price shocks, but data failures. Operational stress tests ask uncomfortable questions. What if prices are correct, but confirmations are late, or margins are unclear? These scenarios do not generate dramatic charts, but they reveal vulnerabilities. They expose dependencies that are invisible during normal conditions. The CME event fed directly into this mindset. It became a real-world data point, validating concerns long discussed in theory. Regulators, too, incorporate such events into systemic oversight. They evaluate not only the cause, but the collective response of participants. A calm response is seen as a sign of maturity. Panic, even without losses, signals fragility. In this case, the response was restrained, which reassured oversight bodies. Still, reassurance does not eliminate the need for improvement. Incremental changes often follow these events. Adjusted thresholds, enhanced monitoring, and revised escalation paths quietly reshape the system. None of these changes are dramatic, but together they strengthen resilience. Markets evolve through accumulation of small lessons. From a strategic perspective, firms reassessed concentration risk. Dependence on single venues or single data providers became a renewed concern. Diversification is not just about assets, it is about infrastructure. Redundant pathways are costly, but outages are costlier. This realization favors larger, better capitalized institutions. Smaller participants feel the pressure more acutely. As a result, subtle consolidation pressures emerge. Firms that cannot afford redundancy must accept higher operational risk. This dynamic rarely features in public debates about fairness, yet it shapes who survives and who exits over time. Another long-term effect is cultural. Teams that live through the disruption carry forward a heightened sensitivity to anomalies. They trust dashboards less blindly, they cross-check more often, question assumptions, and value skepticism. Skepticism is not cynicism, it is disciplined doubt, a professional instinct sharpened by experience. Markets reward this instinct over time. Those who question calmly outperform those who assume blindly. The event also highlighted the limits of automation. Automated systems excel at speed but struggle with ambiguity. When data quality degrades, humans must step in. That transition is where preparedness matters most. Firms with clear manual override protocols navigated the moment smoothly. Those without them hesitated longer. This reinforces a critical lesson. Automation should augment judgment, not replace it. Purely automatic systems are brittle. The CME reporting disruption did not expose a fatal flaw. It exposed a truth professionals already knew but rarely articulate. Markets are robust, not because they never fail, but because participants expect failure and plan accordingly. This mindset contrasts sharply with popular narratives of invincibility or collapse. Reality sits between those extremes. As memory of the event fades, its lessons persist in quiet adjustments. The market moves on, but it is not unchanged. Each disruption subtly rewrites the playbook. The pages are not public, but they guide future decisions. Understanding this helps explain why markets sometimes react strongly to small signals. They are responding to accumulated memory, not just current news. What appears irrational from the outside often reflects invisible context inside. Context built from moments like this one. The CME reporting disruption was not a headline event. It was a professional event, significant precisely because it stayed controlled. In that control lies the real story, a system tested, stressed, and adjusted without spectacle. And in markets, the most important evolutions rarely announce themselves loudly. They happen quietly beneath the surface, where trust is rebuilt one assumption at a time. Over time, the conversation around the event shifted from what went wrong to what nearly went unnoticed. That shift is important because it highlights how modern market risk often hides in the absence of drama rather than its presence. Silence in markets is not neutrality. It is a condition that demands interpretation. Professionals are trained to treat unexplained calm as a signal, not a comfort. As weeks passed, data showed no lasting distortion in prices or settlement outcomes. Yet internally, firms recorded the episode as a reminder that smooth outcomes do not imply smooth processes. This distinction between outcome and process defines institutional thinking. A good result achieved through fragile means is still a warning. Risk managers revisited internal assumptions about data certainty. Many realized their models implicitly treated reporting as binary, either working or broken, with little room for partial degradation. Partial degradation is the most dangerous state. It produces outputs that look plausible enough to trust, but uncertain enough to mislead. To address this, some firms adjusted validation logic, requiring cross-confirmation before acting on certain inputs. This added friction, but friction can be protective when speed becomes a liability. Speed without verification amplifies error. Markets have learned this lesson repeatedly, often at great cost. Another subtle adjustment involved trade timing. Certain desks began clustering execution more tightly around periods of maximum reporting clarity. This behavior does not change total exposure, but it changes exposure to uncertainty. Timing becomes a form of risk management rather than just execution optimization. The event also revived discussions about human oversight. Automated alerts are useful, but alerts without interpretation are noise. Teams debated escalation thresholds, asking when a discrepancy becomes an incident. That line is subjective, but clarity reduces hesitation when minutes matter. One of the most revealing outcomes was how little retail awareness existed. The public largely remained unaware that anything unusual had occurred. This gap in awareness is not accidental. It reflects how institutional markets absorb stress internally to prevent external panic. Critics sometimes interpret this as secrecy. In reality, it is containment, a deliberate effort to localize uncertainty. Financial systems cannot afford to externalize every anomaly. Doing so would erode confidence faster than any technical failure. Yet containment carries responsibility. If internal absorption fails, consequences escalate rapidly. This balance between transparency and stability defines modern market governance. It is a dynamic equilibrium, constantly renegotiated. The CME event demonstrated that equilibrium in action. Information was managed, not hidden, calibrated to the audience that needed it most. Clearing members received what they required to act prudently. Regulators received what they needed to assess systemic risk. The public received normal market function. That outcome was not luck, it was design. Design, however, must evolve. Each real-world test exposes assumptions that theory cannot. This is why post-event documentation is exhaustive. Every timestamp, decision, and deviation becomes material for future resilience. Some firms discovered that their internal dashboards lagged reality. Others learned that too many alerts dilute attention. Attention is a scarce resource under stress. Systems must prioritize clarity over completeness in critical moments. This insight led to streamlined interfaces and clearer escalation paths. Simplicity emerged as a competitive advantage. Another lesson concerned vendor dependence. Third-party data providers form hidden layers of infrastructure risk. When exchanges experience issues, downstream providers may amplify or distort the signal. Firms began mapping these dependencies more rigorously. Dependency mapping is tedious but essential. You cannot manage risk you have not identified. The event also influenced conversations about regulatory coordination. Global markets do not respect jurisdictional boundaries. A reporting issue in one venue can affect participants regulated elsewhere. Coordination protocols matter even when outcomes are benign. Regulators quietly shared observations, aligning expectations and best practices. This collaboration rarely becomes public, but it shapes oversight culture. Culture, more than rules, determines response quality. Rules define boundaries. Culture defines behavior within them. The culture revealed here was cautious, disciplined, and adaptive. Those traits do not eliminate risk, but they reduce amplification. Amplification is the true enemy of stability. Small problems become crises when responses magnify rather than absorb them. This is why seasoned professionals fear feedback loops more than single-point failures. Feedback loops turn noise into motion. The CME reporting disruption did not trigger such loops. Participants recognized uncertainty and dampened reactions. This damping effect is learned behavior. It is built from past episodes where overreaction proved costly. Memory in markets is asymmetric. Losses are remembered more vividly than smooth recoveries. That memory informs instinctive restraint. It teaches when not to act. Ironically, knowing when not to trade is as important as knowing when to trade. Silence can be a strategic position. This perspective rarely appears in popular trading education. It is acquired through exposure, not instruction. The event reinforced that markets reward patience during ambiguity. Those who waited lost nothing. Those who forced action risked error. From a systems view, the episode validated redundancy strategies. Firms with layered controls experience less internal stress. Stress is not just financial. It is cognitive, operational, and organizational. Reducing stress preserves decision quality. Clear thinking is the most valuable asset during anomalies. Leadership also played a role. Calm guidance prevented speculation from dominating internal conversations. Speculation thrives in information vacuums. Leadership fills those vacuums with context and restraint. Where leadership hesitated, rumors filled the gap. This difference shaped internal confidence more than external conditions. Confidence is contagious, so is doubt. The CME event showed how quickly doubt can emerge without visible cause. It also showed how quickly it can be contained with disciplined response. Contained does not mean forgotten. The experience becomes part of institutional DNA. New hires hear about it as a lesson. Veterans reference it when future discrepancies appear. This continuity is how markets learn without collapsing. Knowledge transfers quietly, generation to generation. Looking forward, the relevance of such events will increase. Markets are becoming faster, denser, and more automated. Each improvement in efficiency tightens coupling. Tight coupling reduces margin for error. Therefore, resilience must scale alongside speed. Infrastructure investment is not optional, it is existential. The CME reporting disruption was small in duration but large in implication. It reminded participants that perfection is an illusion. What matters is not avoiding all disruption, but responding in ways that preserve trust. Trust, once shaken, is expensive to rebuild. In this case, trust bent but did not break. That outcome reflects preparation more than luck. Preparation is invisible until tested. This event was one such test. And like all good tests, it revealed more about readiness than about failure.